Welcome to Course '07 of the MaxLife Commercial Academy. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC. And today we're tackling one of the most consequential decisions a business owner will ever make. Should you lease your commercial space or should you own it? This isn't a simple question, and the answer isn't always obvious. But with the right framework, the one we're going to build together in this course, you'll be able to run the numbers, understand the tax advantages, and give your clients or yourself a clear, confident answer. Let's get into it. Every business owner who walks into this conversation brings one of two instincts. The first is the lease mindset. Keep capital in the business, stay flexible, don't tie up resources in real estate. That's a completely legitimate perspective, especially for early stage companies or businesses in rapidly changing industries where location flexibility matters. The second is the ownership mindset. Stop paying a landlord, build equity, control your occupancy costs, and use your real estate as a second engine of wealth creation. Here's the thing. Neither perspective is wrong on its face. The problem is that most business owners make this decision based on gut feel rather than actual numbers. A tenant who's been leasing for 15 years may have paid more in rent than the building would have cost to buy. But an owner who bought at the wrong time in the wrong location may have had their equity wiped out by a market shift. Our job as advisors is to replace instinct with analysis. We build the model, we stress test the assumptions, and then we let the numbers make the case. The cost of occupancy framework is the foundation of this entire analysis. Most business owners compare a lease quote to a mortgage payment and stop there. That's a mistake because it ignores at least 6 or 7 major cost categories on each side of the ledger. On the lease side, you need to account for base rent, triple net expenses like taxes, insurance, and CAM, rent escalations, typically 2 to 3% per year, plus the real but often ignored cost of disruption when you have to move at the end of a lease term. On the ownership side, you're modeling debt service, principal and interest, property taxes, insurance, maintenance reserves, and critically, the opportunity cost of whatever capital you put into the down payment. If you put $500,000 into a down payment, that capital isn't sitting idle. It has an alternative use at some rate of return, and you need to account for that. The revenue benchmark I use is 10%. If your occupancy cost, whether you lease or own, exceeds 10% of gross revenue, the space is probably working against you. That benchmark helps business owners contextualize the numbers in terms of their actual business performance, not just an abstract cost comparison. If there is a single concept in this entire course that has the power to change a business owner's decision, it's the SBA 5004 loan program. I cannot overstate how dramatically this program shifts the lease math in favor of ownership for qualifying businesses. Here's the structure. The SBA 504 is a three-party deal. The conventional lender, a bank, covers 50% of the project cost. The Certified Development Company, or CDC, covers 40% through a debenture backed by the SBA, and the business owner puts in just 10% down. On a $2 million property, that's $200,000 to own your building versus potentially $500,000 in a conventional deal. That difference in capital preservation is enormous for most operating businesses. The 40% CDC piece carries a fixed rate tied to long-term treasuries and fully amortizes over 25 years. No balloon payment in 5 or 7 years. That's critical because balloon payment risk is one of the biggest arguments landlords use against ownership. The SBA 504 eliminates it. When I'm building a lease versus own model for a client, I always run the ownership scenario with SBA 504 assumptions first. In most cases, that's the scenario that makes ownership pencil. At MaxLife Commercial, we help business owners connect with SBA 504 lenders and structure these transactions from start to finish. You can reach us at 321-586-2121 or at maxlifedevelopment.com/academy. Now we get into the mechanics. Building this model does not require sophisticated software. Excel works perfectly. You need two columns, one for leasing, one for ownership, and you need discipline about including every material cost category on both sides. Start with the lease column. Take the year one quoted rent, add your NNN estimates, typically $6 to $12 per square foot for taxes, insurance, and KM in Central Florida markets, and apply a 3% annual escalation. By year 10, that rent is meaningfully higher than it was in year 1, and that escalation is often invisible when business owners look only at the current quote. In the ownership column, start with total project cost, purchase price plus closing costs. Back out the SBA 504 down payment. Calculate annual debt service using current blended 504 rates. You can get this from a CDC lender or use a conservative estimate and then update it. Add a maintenance reserve of roughly 1% of building value per year. Then add the opportunity cost of the down payment at whatever rate of return the business owner reasonably expects from alternative investments. I typically use 6 to 8%. Now here's where the ownership column gets powerful. You add back two benefits. First, equity buildup from principal pay down. In year 1, this is modest, but it accelerates over time. Second, property appreciation. I use 3% annually as a conservative assumption in Florida markets, though actual results often exceed that. When you sum both columns over 10 years and compare the net figures, you often find that the gap between leasing and owning is smaller than the business owner expected. And in many cases, ownership is clearly superior on a pre-tax basis. Then we move to the after-tax analysis, which is where ownership truly separates itself. The after-tax analysis is where the ownership argument becomes nearly impossible to argue against for profitable businesses. Let's talk about depreciation, because this is the concept most business owners do not fully understand. When you own a commercial building, the IRS allows you to depreciate the improvements, not the land, over 39 years on a straight line basis. That creates a non-cash deduction every year. On a $2 million purchase where land is valued at $300,000, you're depreciating $1.7 million over 39 years. That's roughly $43,000 per year in depreciation expense you can write off against ordinary income without spending a single additional dollar. At a combined federal and state effective rate of 35%, that's $15,000 per year in real tax savings from depreciation alone. Now layer in a cost segregation study. A cost segregation engineer can reclassify portions of your building, personal property components, land improvements, into 5, 7, and 15-year asset classes, allowing accelerated depreciation in the early years of ownership when your effective tax rate may be highest. This can generate significant additional tax savings in years 1 through 5. The tenant, by contrast, gets a clean deduction on rent, which is useful, but it produces no equity, no balance sheet asset, and no compounding benefit. When you show a business owner the after-tax model, you're not just comparing occupancy costs anymore. You're comparing the business owner who rents against the business owner who owns. And over 10 years, the wealth gap between those two outcomes is often measured in hundreds of thousands of dollars. Knowing the framework is one thing. Delivering advice that a business owner actually acts on is another skill entirely. Here are the 8 steps I walk through when advising a client on this decision. First, confirm revenue stability. The ownership model assumes the business will be around to occupy the building and service the debt. I want to see at least 3 to 5 years of consistent revenue before I recommend ownership. A startup leasing its first space is almost always right to lease. Second, assess the space needs horizon. If the client tells me they expect to triple their headcount in 3 years, I pump the brakes on ownership of a fixed building. Flexibility has real value, and I need to honor that. Third, run the 504 qualification early. There's no point doing a full ownership analysis if the client doesn't qualify for the program that makes it financially viable. Get a CDC lender involved at the beginning. Fourth, stress test the model. Run your projections with zero appreciation and a higher interest rate. If ownership only works under optimistic assumptions, say so honestly. Fifth, present the equity outcome, because the balance sheet comparison at year 10 is often the most powerful moment in the entire conversation. Sixth, involve the CPA. I provide the real estate analysis. The accountant confirms the tax impact. That partnership makes our advice bulletproof. Seventh, address the emotional objections, particularly the "I don't want to be a landlord" concern, which I hear constantly. As an owner-user occupying your own building, you are the tenant. The management burden is minimal. And eighth, close with clarity. Give the client one number and one sentence. Over 10 years, owning this building puts you approximately $400,000 ahead of leasing. Do you want to move forward? That's how decisions get made. That wraps up Course 07, User Decision Analysis, Lease-vs-Own. You now have the full framework. You understand the two perspectives business owners bring to this decision: how to build a rigorous cost of occupancy model, why SBA 504 financing changes the math so dramatically, how to construct the Excel comparison step by step, how to layer in after-tax analysis and depreciation, and how to turn all of that into advice that actually moves a client to a decision. If you're a business owner evaluating your own space, or a broker who wants to add this kind of advisory capability to your practice, I'd love to talk. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC. You can reach me directly at 321-586-2121 or explore all of our free courses at maxlifedevelopment.com/academy. Up next is Course 08, Investment Analysis and Risk, where we shift from the owner-user perspective to pure investment underwriting. I'll see you there.